What if I told you that most seniors are quietly handing back tens of thousands of dollars in Social Security benefits, not because of bad luck, but because of simple, avoidable mistakes? A study analyzing retirement outcomes for over 2,000 Americans found that claiming and planning errors cost the average senior more than $50,000 over the course of retirement. $50,000 gone. And the most painful part? These are not exotic financial blunders. They are everyday decisions that millions of people make every single year, often on the advice of people who should know better. Today, we are going to change that. Stay with me, because number one on this list might completely change how you see your retirement. Here is the data that stopped me in my tracks. A financial research center tracked over 10,000 retirement outcomes across a 15-year period, and what they found was staggering. When seniors stack the wrong Social Security decisions on top of each other, the gap between what they actually collect and what they could have collected reaches an average of $111,000 in lifetime benefits. Not a rounding error. 6 figures left on the table. If you are 60 or older right now, this video was made for you. And I want you to hear this clearly. If you have been confused about Social Security, if you have gotten 10 different answers from 10 different people, if you have felt like the rules were designed to trip you up, you are not wrong. You are not careless. This system was never designed to be simple. But starting right now, you are going to understand it better than most. So, let's fix that. Starting with mistake number 10. Number 10. Claiming at 62 without running the numbers. This is the single most common entry point for financial loss in retirement, and it happens every single day across America. Here is how it works. When you claim Social Security at 62, you lock in a permanent reduction of up to 30% compared to your full retirement age benefit. Not temporary, permanent. And yet a study analyzing early claimants found that fewer than 1 in 5 had ever calculated their break-even age before filing. That means the vast majority made one of the biggest financial decisions of their life based on a feeling, not a number. Think about what that actually costs. Someone receiving $1,500 a month at 62 could have received close to $2,100 a month by waiting until 67. Over 20 years, that difference compounds into tens of thousands of dollars of lost income. Here is the crucial detail. The Social Security Administration offers a free online calculator at ssa.gov. Use it before you make any decision. Run your numbers at 62, at 67, and at 70. See what the gap looks like, then decide. Number 9. Ignoring spousal benefits. This is invisible money hiding in plain sight, and millions of married seniors walk right past it every year. Many couples assume Social Security is simple. Each person claims their own benefit, and that is the end of it. But that is not how the system works. A spouse may be entitled to up to 50% of the higher earner's benefit at full retirement age, even if they worked very little or not at all. Research on coordinated claiming strategies shows that married couples who plan together rather than filing separately and independently, can add between $15,000 and $30,000 in combined lifetime benefits. The game-changing tip here is this: do not make your claiming decision alone. Sit down together, look at both benefit amounts, and model the timing as a team. 2 poorly timed individual decisions can cost far more than one well-coordinated joint strategy. Number 8. Not accounting for the earnings limit while working. This one blindsides people every year, and the shock of it causes real financial damage. If you claim Social Security before your full retirement age and you are still working, the SSA will temporarily withhold benefits once your earnings cross a set threshold. In recent years, that threshold has sat around $22,000 annually. SSA data shows that tens of thousands of seniors are hit with unexpected benefit reductions every single year, because they did not know this rule existed. Now, here is the important reassurance. The withheld benefits are not gone forever. They get factored back into your payment once you reach full retirement age. But the short-term cash flow disruption causes many seniors to make reactive financial decisions, tapping savings early, taking on debt that create problems long after the withholding period ends. The pro tip is straightforward. If you are still working, calculate your expected annual earnings and compare them against the current earnings limit before you file. One simple calculation can save you from a very unpleasant surprise. Now we are moving into the mistakes that are less obvious, but often more expensive. Number 7, surprises almost everyone. Number 7, forgetting that Social Security benefits are taxable. This is the tax trap that almost nobody warns you about. Depending on your combined income, up to 85% of your Social Security benefits can be subject to federal income tax. IRS data shows that roughly half of all recipients pay taxes on their benefits, yet surveys find the majority had no idea this was even possible when they first filed. Here is how it works. The IRS adds your adjusted gross income, any non-taxable interest, and half of your Social Security benefit together. If that total crosses certain thresholds, a portion of your benefit becomes taxable. Pulling too much from a traditional IRA in the same year can push you over without you realizing it. The crucial detail is this. Withdrawals from a Roth IRA do not count toward that combined income calculation. Coordinating which accounts you draw from and when can legally keep more of your benefit tax-free. Number 6, not checking your earnings record for errors. Your Social Security benefit is built on your 35 highest earning years. If even one year is missing or misreported, your monthly payment is permanently lower than it should be. A study by a leading financial advocacy organization found that a significant percentage of earnings records contain at least one error. Errors most people never catch because they never look. Fixing this is simple. Go to ssa.gov, create a My Social Security account, and review your earnings history year by year. The pro tip is to do this at least 3 years before retirement while you still have time to correct any mistakes. Number 5, overlooking survivor benefits after a spouse's death. This one carries real emotional weight, and I want to acknowledge that before anything else. Making permanent financial decisions in the fog of grief is incredibly hard, but acting too quickly or not acting at all can cost a surviving spouse tens of thousands of dollars. Survivor benefits can be substantially higher than your own benefit, yet research shows large numbers of eligible seniors either claim the wrong benefit first or miss the window to optimize entirely. In some cases, claiming your own benefit early while letting survivor benefits grow is the right move. In others, the reverse is true. The pro tip is this. Do not make any permanent Social Security decisions within the first year of losing a spouse. Give yourself time, then get guidance from someone who can model both options for your specific situation. We are now at the halfway point, and this is also where I want to pause and ask you something. We are now at the halfway point, and this is also where I want to pause and ask you something. How many of these mistakes have you already made or were about to make? Be honest with yourself, because recognizing them is the first step to fixing them. Drop your answer in the comments below. Tell us which number hit closest to home. We read every single comment and we do our best to reply. And if this video is already saving you money, please take 2 seconds to hit the like button and subscribe to this channel. It costs you nothing, but it helps us reach another senior who needs this information today. Now let's get back to it, because the final 4 mistakes are where the real money is. Number 4, failing to coordinate Social Security with a retirement account strategy. This is where we need to zoom out, because mistake number 4 is bigger than Social Security. This is a full retirement income mistake, and it is one of the most expensive ones on this entire list. Here is the situation many seniors find themselves in. They claim Social Security early and leave their 401k or IRA untouched, thinking they are being responsible by preserving their savings. But what they are actually doing is locking in a permanently reduced Social Security benefit while allowing a tax-deferred account to keep growing, which means larger required minimum distributions later, which means a heavier tax burden down the road. The math works against them on both ends simultaneously. Now, the opposite approach, drawing down retirement accounts in your early 60s, specifically to delay Social Security, can actually be a very smart strategy when done correctly. Research on income sequencing in retirement shows that optimized coordination between Social Security and retirement account withdrawals can preserve an additional $30,000 to $50,000 over a 20-year retirement compared to uncoordinated claiming. The crucial detail is this: stop thinking of Social Security and your retirement accounts as two separate decisions. They are one interconnected income system, and every choice you make in one area directly affects the other. Model them together or find someone who can help you do that. Number 3, ignoring the Social Security break-even calculation. Most people make their Social Security claiming decision emotionally. Number 3 is what happens when they do. The break-even age is the point at which the higher monthly payments from delaying your claim cumulatively overtake the total you would have collected by claiming earlier. Depending on your individual benefit amounts, that break-even point typically falls somewhere between age 78 and 82. Here is what actuarial data tells us. A significant portion of seniors who claimed at 62 lived well past their personal break-even age, meaning, statistically, they would have collected more total money by waiting. Let me make that concrete. If claiming early gives you $1,500 a month and waiting gives you $2,000 a month, you need roughly 16 years of the higher payment to break even. If you live to 85 or beyond, waiting wins by a wide margin. The pro tip is to not treat this as a universal rule. Your health history, your family longevity, and your other sources of income all belong in this calculation. This is not one size fits all, but it does require doing the math, not just going with your gut. We are down to the final two, and I promised you at the very beginning that number 1 would change how you see your retirement. I meant that. But first, number 2. Number 2, claiming based on emotion or pressure, not strategy. This is the silent killer of Social Security income. And I want to be direct with you about it. The single biggest reason most seniors claim too early is not financial need. It is fear. Fear that Social Security will run out of money before they get their share. Fear that they will not live long enough to make waiting worthwhile. Fear driven by well-meaning family members sitting across the kitchen table saying, "Take the money while you can." That advice comes from love, but it can cost you dearly. Behavioral economics researchers have studied this pattern extensively. What they found is that loss aversion, the powerful psychological pull toward securing money that feels available right now, causes millions of retirees to make suboptimal claiming decisions every single year. It is not a character flaw. It is human nature. But understanding it is how you overcome it. Here is what you need to know about the funding concerns specifically. Yes, Social Security's long-term finances have been debated for years, but current projections still show full benefits payable for years to come. And even in reduced future scenarios, the projected shortfall rarely comes close to justifying the permanent 30% cut you lock in by claiming at 62. The fear, in most cases, does not match the math. The pro tip here is powerful in its simplicity. Separate the emotional decision from the financial decision. Write your numbers down on paper, look at them clearly, then decide. And now, the mistake that ties all of the others together. The one that, if you get this wrong, makes every other error worse. Number 1. Never creating a written Social Security claiming strategy. Here we are, the mistake that makes every single one of the others more likely. And when I tell you what it is, you might be surprised by how simple it sounds. Because the most expensive Social Security mistake is not one wrong decision. It is the complete absence of a decision framework. Research shows that the vast majority of American seniors spend more time planning a vacation than they spend planning their Social Security claiming strategy. Read that again. More time choosing a hotel than choosing when to claim a benefit that will pay out for the rest of their lives. Without a written plan, everything falls apart. Spousal benefits get overlooked. Tax implications get ignored. Retirement account withdrawals happen in the wrong order. Break-even calculations never get done, and fear fills the space where strategy should be. Here is what a basic written Social Security plan needs to include. First, your projected monthly benefit at 62, at your full retirement age, and at 70. Second, your spouse's numbers alongside yours. Third, your estimated break-even age based on your health and family history. Fourth, your planned income sequence showing which accounts you draw from and when. That is it. 4 components, written down, looked at together. The crucial detail is this: you do not need to hire anyone to create a basic version of this plan. The SSA website at ssa.gov offers free tools that walk you through every number you need. Use them. However, if your situation involves a pension, significant savings, or complex spousal dynamics, 1 hour with a fee-only financial planner can realistically return thousands of dollars in optimized benefits. Now let me show you what your retirement could actually look like when you avoid these 10 mistakes. Let's step back from the numbers for a moment, because what we have really been talking about today is not spreadsheets. It is not calculators or claiming ages or tax thresholds. What we have been talking about is the difference between a retirement where you are constantly managing stress and a retirement where you finally have room to breathe. It is the difference between choosing between a prescription and a heating bill and never having to make that choice. It is being able to help a grandchild with tuition, take a trip you have been putting off, or simply close your eyes at night without financial anxiety sitting on your chest. And here's what I need you to hear right now. If you are not yet 70, none of the mistakes on this list are permanent. There is still time to adjust, recalculate, and reclaim what is yours. You did not come this far to leave money on the table. Your retirement is not over. In many ways, with the right moves, it is just beginning. Before you go, I have 2 questions for you. Which of these 10 mistakes were you closest to making? And is there a Social Security question you have been carrying around, one you have been afraid to ask or were not sure where to take? Leave it below. This community is a safe place to ask, and we read and respond to every single comment. If this video helped you, share it with your spouse, a sibling, or a friend who is approaching retirement. One conversation sparked by this video could protect someone you love from a very costly mistake. Thank you for staying until the end. That tells me you are serious about protecting your retirement, and that matters. Take care of yourself, and we will see you in the next one.